What are the complex tax rules for corporate bond income? Imagine earning interest from corporate bonds and wondering how much of that money will actually stay with you after taxes. Well, the tax rules for corporate bond income can be quite detailed, so let's break it down clearly. When you receive interest payments from corporate bonds, they are taxed as ordinary income at both the federal and state levels. That means the interest you earn is added to your total income and taxed at your regular income tax rate. If you sell a corporate bond before it matures, any profit or loss is treated as a capital gain or loss. If you hold the bond for more than 1 year before selling, the gain is taxed at a lower long-term capital gains rate. If you sell within 1 year, it's taxed as ordinary income. Now, if you buy a bond at a discount, meaning below its face value, the difference can be considered a market discount or original issue discount. The accretion of this discount is taxed as ordinary income each year, increasing your cost basis until the bond reaches its face value at maturity. If the discount is very small, below a certain threshold, you might only recognize it as income when you sell or when the bond matures. When you purchase a bond at a premium, above its face value, you can choose to amortize that premium over the life of the bond. This process reduces your taxable interest income each year, which can help lower your overall tax bill. There are some special rules to keep in mind, like the de minimis rule, which applies to small discounts and defers income recognition until maturity. All interest income and accreted discounts are reported as ordinary income on your tax return, while capital gains or losses are reported separately. It's also important to remember that, unlike U.S. Treasury bonds, corporate bond interest is usually subject to state and local taxes, which can cut into your after-tax returns. For passive income investors, understanding these tax rules is key. Since interest is taxed at higher ordinary income rates, it's wise to consider bonds purchased at a discount or with amortizable premiums as part of your tax planning. Holding bonds until maturity can simplify your tax situation by avoiding capital gains taxes, but market conditions and your liquidity needs should also influence your strategy. To sum up, corporate bond income tax rules involve paying taxes on interest and accreted discounts as ordinary income, paying capital gains taxes on sales, and possibly amortizing premiums. Knowing these rules helps you plan better so you can keep more of your passive income from bonds.